So happy New Year to everyone. In this webinar, we are going to touch upon a combination of two topics, one which we have covered quite a few times in the past, which is the difference between long-term horizon and short-term horizon of investment in equities. And the second topic that we'll merge with it is a sort of psychological topic of loss aversion. For those of you who have read Thinking Fast and Slow by Daniel Kahneman, you would have come across the concept of loss aversion explained there by Kahneman and Tversky long back. So let me jump into loss aversion first, and then I'll try to marry the time horizon element to give out some outcomes that are very relevant for investors, particularly in equities, and how you need to be consciously aware of why the merger of the two subjects can actually give you either opportunities to make more money or especially bring about risks that you have to avoid. So talking about loss aversion first, which effectively in summary means losses loom larger than gains. What that practically means is that we as human beings, we are very terrified by losses. We are very scared of losses. We are scared of losing things which are close to our hearts or wallets, and hence it applies to the financial investments as well. The chart on the right shows you that the impact of a $10 gain is far less than the impact of a $10 loss, psychologically speaking. And in Thinking Fast and Slow, Daniel Kahneman had actually quantified this, and he had said that the impact of a loss is roughly twice as much as the impact of a gain on our emotions as human beings, which is what the chart on the right depicts. And he had also quantified that the riskier the situation, the more pronounced this dislocation between quantum of impact from a gain versus quantum of impact for a loss becomes. Right. So that's the technical definition. It has too many practical consequences, many of which we deal with every day. Some of them you might have come across if you've understood this theory in the past. You might have come across things such as say rather than a Netflix asking you to subscribe because they have certain content, they say that why don't you take a trial? Because once you take a trial, the call will not be to subscribe because of a gain. The call will be to unsubscribe because you will lose access to the content, right? So the feeling that you get when you're being offered a gain is far lower in quantum than the feeling that you get when you're offered a loss, right? And hence loss of content on Netflix, for instance, is far more painful than the gain of content. And hence all of these subscriptions, I mean, whether you subscribe to say Wall Street Journal or Netflix or many other things in life, they give you a free subscription. In a way, the discount mechanism is also very similar. So I remember last weekend, actually just day before yesterday, there was this Republic Day sale on Amazon Prime in India, right? Which meant that if you were a Prime member, then on 14th January morning, which was Saturday morning, Amazon Prime offered you some extra discount valid only for one day, right? Now, what that will do obviously is if you really needed to buy, let's say, a mobile phone, your previous mobile phone had literally conked off on Friday. If you needed to buy that mobile phone, then you'll get that mobile phone at a cheaper price if you buy it on Saturday than if you buy it on Sunday. That's true. But what if you needed to buy a mobile phone after another 6 months? And you're being told that for one day, you'll get a couple of thousand rupees extra discount in the month of January. Now, had this discount not been offered, you would have bought this phone somewhere in June, but because of this discount, you'll probably buy it in Jan. And that again is related to loss aversion, where you have something in hand, an opportunity to buy at a lower price, and you're being told that that opportunity will be taken away from you within a day. That's far more painful to you than the pleasure that in 6 months you can buy a phone at obviously an unknown price. And hence the discounts, the trial periods, all of these concepts, they work really well. Now, this is something that we live with every day. We are perhaps used to. In many cases, we might be all right with some of the extra shopping we might do because of the concept of loss aversion being played by somebody like a Netflix or somebody like an Amazon with our minds on a day-to-day basis. But it has massive investment implications for equities, right? And let me straight away come to that. So whenever you look at your equity portfolio, right, you get pleasure or disappointment basis either absolute return or relative return or both, right? Absolute return obviously is the rate at which the portfolio has compounded over a certain period of time. Relative return is the way this portfolio has compounded relative to either a benchmark or relative to, say, fixed deposit or relative to something else, right? Relative performance is in effect comparison with a substitute opportunity, or you can call it lack of relative performance means opportunity loss, and lack of absolute performance means maybe capital loss, right? So that's the way in which you measure any portfolio's performance. Now, as a result, you can build this 2x2 matrix, right? Where you say that, look, if I have a positive absolute return, which means my wealth has compounded, and a positive relative return, which means substitutes would have been inferior in quality, then I'm better off. That's the blue quadrant, bottom right, blue quadrant. You have no loss and you're happy, right? But if you undergo a loss of either an opportunity or capital or both, then going by the loss aversion theory of Daniel Kahneman, the happiness quotient in terms of the quantum will be greater, and obviously in direction it's reverse. So if you go for a blue quadrant, let's say you make 1 unit of happiness by looking at the portfolio performance in equities. If you go for the yellow quadrants, where you've lost 1 parameter, haven't lost the second parameter, let's say, and we are just using simple rounded figures. Daniel Kahneman didn't quantify the 2x2 matrix of equities like this, but we are just doing it for simplicity's sake. Let's say the yellow quadrants gave you 2 units of dissatisfaction or sadness, right? Despair. And if you were in the red quadrant, where you underperformed versus the benchmark and you lost some capital, then that's actually the most painful situation when you look at your portfolio returns. Obviously, you all can relate to why I've brought up this slide and why the red quadrant is what many of us will be living through in our portfolios when we look at a 3-month, a 6-month, a 12-month return. And hence, this concept has a lot of relevance, and I'll come to it when we talk about merger of this concept with long-term and short-term time horizons, right? So bear this 2x2 concept in mind. We'll come back to it. I'll recap it after a few slides. Now, coming to long-term versus short-term time horizon. So this is a chart which, for those of you who have read Coffee Can Investing and Diamonds in the Dust, it's a chart picked up from those books, right? This particular cutout is from Diamonds in the Dust. It is exhibit number 80 in Diamonds in the Dust. And the same chart, updated till 2018, was there in Coffee Can Investing as well, which you can refer to. Let me very quickly tell you how to read this chart, and then we'll just play around a little bit with it. So the way to read this chart is the vertical bars are outperformance of the filter-based CCP portfolios. Remember, when we wrote the 2 books, Diamonds in the Dust and Coffee Can Investing, we had highlighted a DIY, do-it-yourself approach towards building portfolios where you look at sort of 10 years revenue growth, 15 years return on capital, consistently over a very long period of time, and you build portfolios like that. And hence the books had talked about the outcome in terms of performance of these charts, and Diamonds in the Dust is the book which we are referring to here. It had exhibit number 80, which has this chart, right? Vertical bars indicate outperformance of the CCP investing approach, the filter-based CCP investing approach, versus Sensex. If the vertical bars are standing up, it's outperformance. If they're hanging down, it's underperformance. The dotted line is the return of those filter-based CCP portfolios, and the solid line is the return of Sensex, right? This is Diamonds in the Dust chart, copy pasted from there. Now let's play around a little bit with it. If you convert this into an NAV, right, net asset value, the way, let's say, a mutual fund or even your consistent compounders portfolio at Marcellus has an NAV. If you convert this into an NAV, this is how it looks, right? It's quite a beautiful sight where the CCP line is shooting up in the sky, and the Sensex line is reasonably flat, right? You can see the quantification of the CAGRs as well over a 20-year period. The CAGRs are about 8 percentage points apart, 21 versus 13. And the red line is opening up the gap against the blue line quite consistently as time progresses, right? Obviously, a very happy chart. I don't think anybody would feel sad if they had looked at this chart as part of their investment portfolio, right? But let us look at few variants of this now. So if we were to just define a legend, right? Again, back to that 2x2 matrix, where positive relative return, positive absolute return gives you a blue shade. Yellow shade is either negative relative or negative absolute, and red shade is both negative relative and negative absolute. And if you had a 3-month time horizon, as in at any point of time on the horizontal axis, you looked at the preceding 3 months, and that defined the color code of that timestamp, right? So I repeat, at any point of time on the horizontal axis, the color code of the bar on top is defined by what the last 3 months performance was on that 2x2 legend of blue, yellow, and red colors. This is how it would have looked, right? So if an investor has a habit of looking at their 3-month performance on their account statement, then very few times that investor will have a blue shade, which is a satisfactory period, right? And very frequently, they will have either a yellow or a red, which are both loss aversion oriented unhappy shades, right? The moment this investor increases the time horizon to 1 year from 3 months, this is how the shades change. The moment you do 1 year, and 1 year is exactly the exhibit 80 of Diamonds in the Dust. In fact, that exhibit 80, which had a 1 year time period, the shade would be far more blue, far more frequently than for the 3-month investor, right? I'll go a little slow here because it's important to digest.
But explaining to people why the blues increase in 1 year versus three months. It's worth explaining to people why that happens.
Yeah, so let me explain it once, because we'll use this template repeatedly for the next half an hour, and it'll be a lot of fun when you understand how psychology plays games with our mind in equity investing. So when you go back to this 3-month period, let's say you look at maybe 2012, right? A lot of yellow red period where I hope you can see my cursor. A lot of yellow and red stuff here, no blue, right? This is somewhere around 2012. Why is it yellow or red? Because in the preceding 3-month period, around this time, you had the Sensex either outperforming versus the portfolio, or the portfolio giving a negative return in absolute terms, or both, right? Red color means the portfolio underperformed the Sensex and it gave a negative return. Yellow means it either underperformed the Sensex, which obviously is not a happy outcome. You lost an opportunity to make more money in Sensex, or you lost capital because you might have beaten the Sensex, but you still lost money. You could have actually just sat on cash, right? If you go by that logic, somewhere around 2012, somewhere around 2007, somewhere around 2002, 2001, there are lots of yellows and reds. But the moment you look at this chart, many of those yellows and reds are gone, because whilst for a particular time period, in the preceding 3 months, you might have underperformed versus the Sensex, but in the preceding 12 months, you might have outperformed versus the Sensex. Or in the preceding 3 months, you might have had a negative return, but in the preceding 12 months, you might have had a positive return. So if you as an investor open your statement, negative return for 3 months, but positive return for 12 months, depending on which of the two time frames you look at, you'll have a different emotional reaction to that chart, right? If you're focused on the 3 months, this is how you would have found the outcome of your portfolio's performance. If you're focused on the 1 year, this is how you would have found that. Why? Because obviously over a 1 year period, something that had fallen might have recovered and you are still in the money. You still made money, positive return, positive absolute, etc. Now, it gets more interesting when you go to 3 years. This is 3 years for you, right? There's a very limited time period of red, a little more time period of yellow, and that was the infra rally of 2004-5, right? And this yellow is all relative. If you see, absolute returns are not negative during the yellow period. It's only the relative returns which were negative, right? They were negative to the degree of minus 10% alpha, minus 15% alpha, etc. And hence, there was a little bit of a disappointment, obviously, to an investor in CCP portfolio with a 3-year horizon as well, right? And there was some yellow here. Obviously, in the filter-based portfolio, there was underperformance during 2017-18 because the filter-based portfolio had picked up lots of housing finance companies, which had pumped the portfolio valuation downwards during the AQR and various other events around 2017-18. And there was underperformance again, right? Absolute returns over a 3-year period were never a worry. You didn't have a yellow because of absolute returns, but you had yellow because of relative returns twice over a 20-year period. You increase this time period to 5 years, the yellow of 2017-18 is gone. The red of 2003, 2004 is gone. A little bit of yellow is still left. Largely, the whole line is blue. And you increase the time period to 7 years, this is all blue. There's no yellow, there's no red, right? So that's what happiness can do in a way if you change the time periods, right? This is a summary. Remember, chart on top is a simple NAV line. It looks very beautiful when you look at only the chart on top, because you can see the jaw opening over a period of time. What you don't know is that during this journey of jaw opening in the chart on top, if you had a 3-month horizon, you would have actually had more dissatisfaction than happiness during the 20-year journey. If you had a 1-year horizon, you would have had a lot more blue, 3-year and 5-year, predominantly blue, right? So that's one very interesting way to look at performance in the past. Now, this then has to interplay with loss aversion, which is quantification. Loss aversion, remember, is the quantification that losses hurt twice as more as gains give you the pleasure, right? Losses hurt twice as more as gains give you the pleasure. So if you were to apply these values to the color codes, as in every time there is a blue, you say, okay, happiness quotient goes up by 1. Every time there's a yellow, it goes down by 2. And if it's a red, it goes down by 3, let's say. And you can change these numbers, the conclusions will be the same. This is how the outcomes will evolve. So this is your NAV chart of, book CCP in this chart effectively means the Diamonds in the Dust Exhibit 80 book, right? So this is the Diamonds in the Dust chart, NAV going upwards. But if you have a 3-month horizon and then you weight every instance by the happiness quotient defined in the previous 2x2 matrix, as in a blue shade is +1, but if it's a yellow shade, it's -2. And then if you did a cumulative worm plot, a cumulative NAV plot of happiness index, let's say, right? This is how you would be looking at. The chart never comes upwards, which is that every incremental time period adds more to the unhappiness, sadness, despair. And hence, as time progresses, the chart on the right is only going downwards. Because as time progresses, you get more yellows and reds and less blues. Blues will lift the chart up, yellows and reds will pump the chart down at a faster pace than the blues, right? Because there are very few blues in a 3-month time horizon, the chart pushes down, and an investor who opens up their investment performance scorecard and look at only the 3-month returns and then question themselves whether they took the right decision to invest in the portfolio or not. That investor over the last 20 years, as time progressed, became worse in the happiness quotient or became more sad with the outcome, despite the fact that they compounded their NAV by 21% CAGR.
I think Rakshit is just worth explaining that in the 3-month horizon, it's a double whammy, right? It's a double whammy because there are very few blues, right? And secondly, because the human mind has lost aversion, the yellows and reds completely depress the life out of you. That's why in investing, people who keep looking at their statement very frequently, or traders who keep looking at their position all the time, it's a combination of, in the shorter the time horizon, the more yellows and reds you get. And then, as Kahneman picked up, the loss aversion kicks in and you basically drive yourself to a suicidal position of sadness.
Correct. Right. Now, this is how the chart moves if you had a 1-year time horizon. Right. On a 1-year time horizon, obviously, you had some period where your sadness kicked in consistently from 2005 to 2008. The chart was only going downwards. Right. And then there was a period when you got happier and happier. But every happy period will be followed by a sad period in the last 20 years of investing in CCP type companies. And net, you're still worse off. Net, you're still in the negative. You're still unhappy, even if you had a 1-year time horizon, right? Because as Saurabh mentioned, the blues are reasonably more frequent on a 1-year time horizon, but the pleasure that a blue gives is roughly half of the pleasure that a yellow gives. And even though yellows are slightly less frequent than the blues in a 1-year time horizon, they add to more dissatisfaction than the blues add to the pleasure, right? As a result, this red worm on a 1-year basis goes down. If you had a 3-year horizon, this is how it would go up, right? Net, massive positive, and on an ongoing basis, only a happy outcome. Effectively, the moment you have a 3-year or a longer time horizon, you start enjoying the chart on the left. If you have a 1-year or less time horizon, you will not enjoy even a 21-22% compounding over 2 decades, which is an 8% alpha as well over 2 decades. You won't enjoy that if you had a 1-year time horizon whenever you picked up your investment statement and looked at the performance of a portfolio, right? And that's the conclusion.
Another way to put this, Rakshit, would be given. Remember, you published that 50 years of analysis of Berkshire Hathway.
So yeah. Saurabh, I'm coming to that. That's married here. Yeah. I'm coming to that. All right. So this is the next slide. As Saurabh preempted it in a way. This is what we had presented, right? For those of you who don't remember what this is a heat map in terms of monthly outperformance over S&P 500 for Berkshire Hathway. So this heat map was only a relative, but I'll give you the absolute variant as well in a minute. This heat map basically talked about reds being cells where Berkshire Hathway underperformed versus S&P 500, and white being cells where Berkshire outperformed over S&P 500. And half of the times Berkshire outperformed, half of the times it underperformed, and hence now you can see what will happen. Sort of preempted it. I'm sure many of you can do as well. The moment you multiply the whites with +1 and the reds with -2, you can see where the satisfaction index or happiness index of an investor in Berkshire Hathaway is headed. And this is how it will look. If you had even a 1 year time frame, right? Forget about 3 month or 1 month. If you had a 1 year time frame on Berkshire Hathaway, you'll have too many yellows and reds and relatively few blues. Now, somebody can argue, well, Berkshire outperformed. You can see the blues more often during the 80s, the 90s. It's the last 2 decades where it has had more mixed colors. So at least during the 80s and 90s, 1 year was good enough a time frame to look at Berkshire Hathaway, right? I'll come to that in a minute, the answer to that. This is a 3-year chart. More blues, very few yellows, reds. Again, the argument can be here that 80s, 90s, it was pretty much all blue. So that was a different way of Berkshire investment. But this is how a 1 year time horizon looked like even during the 60s, 70s, 80s, 90s, which were the best years of Berkshire's history, right? I mean, somebody can always argue the last 20 years of Berkshire were relatively weak, but look at the chart on the right. An investor in Berkshire with a 1 year horizon to assess whether the performance was good or not, and hence whether he should be happy or sad. That sort of an investor, ever since Berkshire started, barring a sort of 7-8 year period between mid 70s to early 80s, where this line went up, that investor's happiness effectively never increased. Never increased.
Same people, Rakshit, the same people who bought Enron in 94, because that person is still
got
sad.
frustrated.
Enron in 94 and Diwala nikal gaya 2002.
Correct. Imagine how can you, in a way, the two charts are trying to answer a question. How can you have the left-hand side chart as your investment portfolio and still be unhappy? I mean, the left-hand side chart is probably the best chart that anybody can have in their portfolio over a time period as long as 60 years, right? And still unhappy. Not because they had 1 month or 3 month time horizon, unhappy even if they had a 1 year time horizon, right? And this is the best that equity investment world has offered so far in a way over a 6-decade long period. So that's something worth thinking about. Now coming to CCP, there are different time periods here. You can choose which of these bars you want to focus on, right? You can choose the 1 month bar and ask us questions. Why did we have a negative 3.7 and an underperformance or whatever? Or you can choose, let's say, the 4-year bar and say 17%. How did we deliver that? It has a 3% alpha. Is that something I should expect every 4 years, every 5 years over the longer term, right? Those are two very different perspectives that you can pick up from the same chart and drive your thought process of assessing whether this is what makes sense for you or whether this is what doesn't make sense for you. How do we differentiate between the two? When we as analysts, fund managers at Marcellus, we look at how to build the portfolios, look at the review of our portfolio performance. We choose certain characteristics, certain attributes of our portfolio, which only talk about the long-term orientation of our expectations. It only talks about the long-term orientation of our philosophy, and hence the long-term orientation of the outcome to our clients in terms of the rate at which NAV compounds. In the last 2 years, particularly, you can actually say in any 2 years, there are lists of short-term attributes that happen to a portfolio and a list of long-term attributes that happen to a portfolio, right? I'll display the list that I would say a small fraction of the list that actually played out in the last 2-3 years for our portfolio, and you'll be able to associate with it, right? So the first bit, now COVID has happened, let's say. We had 2 years of lockdowns, uncertainty in the external environment. The short-term oriented investor, whether it be the analyst or fund manager inside Marcellus or a client of Marcellus, will have questions around the impact of COVID on next quarter or last quarter's revenues or profits. World is shut. Can Asian Paint still sell the paint dabbas? World is shut. Titan can't open the Tanishq stores. Can Titan then report next quarter's healthy revenues, and what impact will it have on the share price? That's the left-hand half. We don't do that, and we advise you not to do that. Otherwise, you'll go to the loss aversion charts, which never go up even for the best performing equity portfolios over the longer term, right? What we do is take the right-hand approach, which is COVID has happened. Let us assess which are the companies that are using the uncertainty to their benefit. For instance, we were actually quite excited to know what Asian Paints was doing with the painters in the month of April 2020, rather than being worried that, look, the June quarter numbers are going to be weak. We were quite excited to know what Page Industries was doing with the incentive structures of the distributors during the COVID crisis, so on and so forth, right? So that's one element where you can choose for the same event 2 different ways of thinking, which gives you the different outcomes of that happiness index over the longer term that we showed in the loss aversion charts. Think about FY22 free cash flows and capital allocation, right? The short-term view is, well, FY22 had negative free cash flows across Marcellus's portfolio companies, and free cash flows, as Finance 101 would tell you, free cash flows in the longer run define the fair value of a business. And here we are in FY22, negative free cash flows delivered in this portfolio throughout. The long-term orientation will say, well, let's just analyze why were the free cash flows negative. Was it because revenues didn't grow, or was it because earnings didn't grow, or was it in fact because capex was abnormally high? And if it was capex abnormally high, which actually was the case in FY22 for our portfolio companies, why was the capex high? It was towards M&A, it was towards tech investments, it was towards complete business transformation, which actually radically has already changed the future growth trajectory of fundamentals of these portfolio companies, right? And hence FY22 capital allocation decisions leading to free cash flows going negative. When you take the long-term orientation, it's actually a very positive outcome that an investor can associate with, rather than just looking at the fact that the free cash flows are negative and hence a negative outcome, which is a short-term oriented approach, right? Think about the Russia-Ukraine war. What it did was it led to commodity prices go up. The immediate knee-jerk reaction from a short-term orientation you can have is margins of Asian Paints adversely affected, margins of Pidilite adversely affected, right? Yarn prices doubled and margins of Jockey adversely affected, so on and so forth, right? That's the short-term orientation. The long-term orientation is, well, margins will be taken care of by the pricing power element of these businesses, so let's not worry about margins for a few quarters. What is quite interesting is supply chains have been disrupted in Jan, Feb, March 2022, and during a disrupted supply chain environment, there are some companies which are taking steps that will ensure that their product availability will be far superior compared to their competitors' product availability in the subsequent 3 to 6 months. And are those companies in our portfolio or not? That's a long-term orientation for an investor, right? Another way to understand is, well, what should I focus on when I hear about Grasim entering in paints, Tata 1mg entering in diagnostics, Geo Finance entering in NBFC space? Well, Well, the share price has tanked for Dr. Lal, for Asian Paints, for Bajaj Finance. Is it because of these reasons? If it is, maybe I should trigger a stop loss, right? Stop loss is actually the worst way to invest in the longer run, because effectively you're saying what falls, I'll chop it off, what rises, I'll hold it more. Whereas a long-term oriented investor will say, well, if these new entrants are coming in, let me first have a deep thought about whether the competitive advantage of our portfolio companies is strong enough to fortify, to defend against the new entrants' attack in future. And if it is, and if we are very confident why a Grasim, a Tata 1mg, a GE Finance might not have a very easy ride entering into this industry against our portfolio company as a dominant player, then let's buy more of the stocks that have fallen without justified concerns on their fundamentals, right? That's a long-term orientation. Effectively, as you go through this list, the choice of left-hand side attributes in your thinking will push your happiness index downwards, even if you are invested with Berkshire Hathway. And the choice of right-hand side list will push your happiness index upwards, and you'll enjoy a 20-25% compounding of a great investment portfolio. Now, whether CCP is great or not is a question you can answer based on your due diligence, but the choice of factors has to be short versus long in this manner, right? Investment in disruptors. I remember when 2021, all these Zomato IPO and Paytm IPO and various other IPOs were coming, lots of questions used to be asked to us. Why do you not invest in disruption as a theme? Disruption is a part of our economy, and we are getting disrupted every day. We totally agree with the fact that disruption is real, disruption is more frequent, and we have to have disruption in our portfolio, only then we'll make money. But investing in disruptive businesses which haven't had any history of governance or capital allocation is a very short-term oriented thought process. It's excitement-oriented thought process. Whereas investing in companies which might have been consistent compounders already and are still disruptors, are still new age companies. The Bajaj Finance entry into fintech, the Asian Paints entry into home decor, the Titan entry into Carrot Lane, phygital jewelry, right? These are examples where you'll find far greater value as an investor than you will in companies where there's more uncertainty than certainty around the prospects of the fundamentals in the long-term future. You can do due diligence by asking two very different questions, right? How is the share price doing, or how is the business doing? If you are asking how is the share price doing because the share price behaved in a certain way, not because the business fundamentals behaved in a certain way, that's short-term oriented thinking, right? And you can always choose which of the two questions to ask, and that will define the outcome in the longer run. When it comes to valuation, right, a subject which actually gets looked at via a single lens of a PE multiple, right? Obviously, everything needs to have a fair value PE multiple, but worrying only about the fact that PE multiple of 40 times is in my portfolio and PE multiple of 10 times is the opportunity substitute. Right? That's not the right way of looking at it, because what's more important is what is the intrinsic value. Something could be cheap at 50 times PE and something could be very expensive at 10 times PE, right? So ask the right questions across all sorts of aspects of investing, and that leads you to very different outcomes, particularly in your happiness index, even if you make the right decision of choosing the right fund manager for the longer run, right? So yeah, I think that's about it, and I'll stop here, and maybe we can take some questions that have come up.
Yep. Thanks, Rakshit. That was lovely as usual. There are some very interesting questions on the subject of behavior. I'll start off with a very honest question from one of our clients. It says, why are you constantly trying to justify the underperformance? The underperformance is truth. Rather than talking about what we can do better, what the portfolio manager can evaluate in terms of other strategies. In fact, this repeated justification of underperformance sort of gives us more jitters than comfort. I think it's an honest question in many ways. I'll add my 2 cents, Rakshit, if you see if you can add, Rakshit and Saurabh, feel free to jump in. I mean, we've done this consciously because we do have, as you know, 9,000 investors invested with us. All of them come with different levels of exposure to the equity markets, different levels of awareness and maturity about their thinking about their investments. Our intention is only to help them with these perspectives about why long-term thinking is helpful. Equity is a volatile asset class. Remember, we have, as a country, added a lot of first-time investors into the equity market over the last 2, 3, 4 years. So to that extent, there is an element of awareness required, and we're doing our bit. In fact, most of our webinars, we've tried to focus on the fundamentals of the companies, which is in terms of the long-term orientation. There are some webinars we choose to focus on using these behavioral aspects. And as Rakshit has beautifully articulated, I think it does help a lot of our investors look at it from the right perspective. For some of them, of course, who've been in the markets, maybe this does come across as a bit defensive, but that wasn't the intention.
Yeah, so I'll just add a couple of instances to actually back what Pramod mentioned. So I remember we had started managing money somewhere in December 18, and either on 1st May 19 or 1st June 19, either of those 2 dates, and the person who's asking the question can actually go back to that time period as well. We had published a newsletter, Why Are We Underperforming the Nifty 50? That was the title of the newsletter. It was a CCP newsletter, right? Were we being defensive? No, not at all. At that time, in fact, the 12-month chart was very good. Even the 6-month chart was very good. It's just that in every content that we put out via a webinar, a newsletter, a book, right, we try to cover up the entire spectrum, where on the one hand we'll talk a lot about don't try to time the market. Now that's not effectively trying to go on the defensive and say that, look, we know you want to time the market, but we don't want you to time the market, and we are spending time more about timing the market rather than about focusing on the fundamentals. Similarly, it's the subject of underperformance, is the subject of various other aspects of fundamentals. So it's a mix of all types of messaging which we keep giving. Obviously, in the last 12 months, more questions have been asked about the near-term performance, and we're trying to move the audience away from that short-termism in their questioning by sharing this sort of a content. And in many ways, trying to articulate how our mind works. What do we do? I mean, this checklist is in a way an example, what is displayed in the screen in front of you. What do we do when we discuss in the research meeting how the results of a particular company have been in the recent quarter, what the annual report said, what a primary data check says, or what an analyst's road trip to say a Kanpur or a Bihar or Tamil Nadu tell us about how business at the ground level is happening, right? So our orientation is all long term. What we don't do, we want our clients also not to measure us via those parameters, and hence I think so this is in no way this is defensive. This is in no way what we worry about. It's just trying to increase awareness.
I think I'll agree with your awareness point, Rakshit, but I don't think at many levels we care, right? Whether people think it's defensive, it's offensive, I don't think I care. What I do care about is I've seen Indian fund managers getting their careers ruined. Forget H&W, such as the people on the line. I've seen Indian fund managers getting their careers ruined by investing in crony capitalist, low quality companies. This cycle happens in our country repeatedly. Very little new happens under the sun, right? As all of us know, people who've been investing for 20 years, the same cycles repeat themselves. We've seen sensible fund managers lose their jobs, lose their careers because they've gone ahead and invested in crap against our advice. This is in our previous avatars in the UK, in our previous avatar in India. We've seen generations of fund managers wiped out again and again. The same mistakes repeat themselves. They will get excited in certain circumstances, go and load up on either crony capitalistic stocks or low quality companies whose balance sheets will implode. Company will fall 95% and the fund manager will lose their jobs. We've seen this happen abroad as well, right? The same psychological weaknesses which result in Indian fund managers getting sucked into this gutter, the same psychological challenges which also destroy British and American fund managers. And by the same token, we've seen our relatives lose money. And I remember some of my relatives lost everything they invested in Reliance Power. And you know, you guys are working hard for your money. Many of you are our clients. Some of you, we hope, will be clients in the future. Having seen professional fund managers being ruined by this focus on क्या चल रहा है last 3 महीने में, what is the alpha the last 3 months, 6 months, 12 months, having seen professional fund managers getting ruined by it, having seen our relatives lose their very hard-earned money, we don't want you to suffer the same fate. Now, if in that process you think it's defensive, well, that's, you know, honestly for you to worry about. Our job, our duty, the reason we exist, the reason we do this job is to give you the way we see the world. What you do with that information is your prerogative, and we'll carry on doing it. It's a privilege, we believe, to have this job where we get to write, do webinars, convey to you our point of view, built on 20 years of very hard work of working with investors across the world. And, you know, to each his own. Those who want to listen to us will listen to us. Those who think it's defensive, don't want to listen to us, it's up to them.
Thank you. Thanks, Rakshit and Saurabh. So, you know, you mentioned about how harmful it is to look at portfolio performance or stock prices on a 3-month or a 6-month or a 1-year basis, but how practical it is to wait for, you know, 3 years and then open up my portfolio statement. What do you recommend is the relevant time period for review? And given that at the end of the day, we are human beings, we can't wish away that loss aversion. How should we react to these inevitable periods of underperformance?
Yeah, I think more than defining a particular time period of review, what comes before the definition of the time period is what attributes should you look for when you check out or when you try to do due diligence, right? Is due diligence all about the performance chart, or is due diligence about the drivers of that performance chart, right? That's far more important. And whilst I totally agree that, I mean, if let's say a particular fund manager has lost his or her discipline, then you don't want to find that out after 5 years because you looked at only the 5-year performance. But if you were to do your due diligence on the relevant attributes, then time period is immaterial, because as long as the due diligence is suggestive of discipline on long-term oriented attributes and quality of delivery on those long-term oriented attributes, performance chart is just an outcome. It's just an output, right? Rather than trying to assess the performance of your portfolio basis the output, it's far better to assess the performance of the portfolio basis the inputs, which naturally will give you the output, right? So that's one way to look at it. In many ways, the job of an investor in, let's say, a Marcellus PMS or any other PMS is not too different from our job as analysts and fund managers. When we assess, let's say, a Titan's competitive advantage and whether Titan is a great business or not, we do not assess Titan's strengths and weaknesses basis what Titan reported in the last 1 or 2 financial periods or 1 or 2 quarters. right? Or even 1 year or 2 years, right? We don't assess Titan basis the last 2 years of balance sheet. We assess Titan basis what have they done in the last 2 years, which will give it a beautiful journey over the next 10 to 20 years, right? So that's in effect the due diligence process. Now, we have found our own longevity framework, call it, and there are many other frameworks that overlay on top of longevity, something that you might have heard us talk about, margin of safety and sustainability. We have our own frameworks that clearly articulate the factors that are important to us. How will we assess them? What is the research process which we'll use to assess them? And we can't just land up in front of Titan's management team or every month and say, Sir ji, bata do, aap kaisa kar rahe ho? That's not what will give us the clear picture. That's not what will give us the conviction, right? And hence, we need to be clear, what are the input parameters that we are going to assess? How are we going to track them on an ongoing basis? What is the process that we'll follow? And if we are building conviction on those input parameters, then output, which is great free cash flow compounding of Titan, it might not happen in the last couple of quarters, or it might have happened in a very massive way in the last couple of quarters, is immaterial. It will happen over the last 5 years. It will happen over the next 5 years if our due diligence parameters are clear and long-term oriented, right? So that's why, in effect, again, coming back to this slide on the screen, this is a better answer than just the time period. Now, having said that, somebody might say, well, we don't have the time to do due diligence on every move that Marcellus makes. We don't have the time to listen to every webinar that Marcellus does and hence do our due diligence. And we don't have the time to ask around in the industry, what are the substitute options, or what is Marcellus's competitive advantage, or are they remaining disciplined with their investment philosophy? We don't have the time for that. If you don't, and if performance chart is the only thing, then short answer to the question that Pramod you relayed, at least a 3-year period, and the longer the better, is what I would say is good for due diligence.
And in the interim, you're saying you should track fundamentals of the portfolio rather than the performance of the portfolio, right? So much like how we track the fundamentals of the company, which is one way of effectively measuring us on the stated investment philosophy, whether we are sticking to that stated investment approach or not. So there are other ways of measuring whether we're doing that or not than just stock prices and portfolio. Stock price, of course, will eventually have to deliver. We can't eat fundamentals. We can't fund our kids' education and retirement. Ultimately, we do need the returns. What Rakshit is saying is, in the long run, those returns will follow fundamentals. In the short run, you're better off following or tracking the fundamentals rather than the performance itself. So there is a way to give yourself the comfort in the short run, and not really simply, shut your minds and wake up after 3 years to see how the portfolio is done. And that's the endeavor, like I said at the beginning of this call as well. That's what we do in webinar after webinar, newsletter after newsletter, stress upon the fundamentals of each of our portfolio companies, go to lengths of explaining how these companies are doing, so that you get the comfort on that.
In that regard, right, everybody who's watching this and everybody who reads the newsletter actually has a great sort of seat in the box office. Think of yourself as an Indian cricket selector, right? When Virat Kohli was going through that bad patch, had you dropped Virat Kohli, imagine what would have happened in the last 4-5 months, starting with that Asia Cup and then the T20 World Cup and his recent run of form, right? So as an Indian selector, right, I think Chetan Chauhan was the chief of selectors. He didn't have any other metric to turn to. He only had the share price. The share price was how many runs was Kohli scoring, and he went through a lean patch where he didn't score very many. And to the selectors' credit, they kept faith in him, and his fundamentals were strong. He's come through. But you guys don't have that problem. You have a simple metric, which is, are these companies compounding their profits and their cash flows, right? Every single Marcellus newsletter, Little Champs, Rising Giants, Kings of Capital, CCP, they're giving you that picture about profit compounding, free cash flow compounding. And pretty much without exception, you can see the portfolios are compounding profits anywhere between 20 to 25%. right? So the share prices in a typical Marcellus portfolio are down 15%. But as long as you can see the profit compounding engine is gunning, you don't have to sit back and hope. It's not as if you have to sort of hope that one day I will make money. If well-run companies are quarter after quarter giving you 20-25% profit growth, you know that your wealth will follow not very far behind. Unlike the Indian selectors, they didn't have a profit wala metric to look to. You and I have that metric, and that should give us enormous amount of clarity that these companies are doing the right thing.
Great, thank you. Thanks, Saurabh. In fact, there was, I think it was a meme floating around. Virat Kohli took 3 years to score his next century. But after that, I think 3 months he followed up with the next century, and 3 weeks the next century. And literally in 3 days, he scored 2 centuries. So,
the new concern is Rohit Sharma, right? He hasn't had, I think, 47 innings.
He'll go through the same patch, yeah.
Now,
and imagine had you missed investing in Virat Kohli in the last 3 months because he had a 3-year bad patch.
But on jokes apart, thankfully there's an Indian team. So whether it's a Kohli fires or a Rohit Sharma fires or a Shubman Gill fires, as a team, we tend to do all right, which is why also having a portfolio of 14, 15 such stocks whose profits are growing at a consistent rate should give you plenty of clarity that this is something which will work for you.
Fair enough. I think enough on the behavioral aspect. There's some specific questions on the short-term versus long-term slide where you highlighted. We'll focus on companies. How are they benefiting from the adversity? What are they doing to do that? Are there any parameters that one can look out for to track? How are these companies actually using this adversity to their advantage? Specific to CCP companies, can we share a few examples?
So I'll log out. Can I just make one point on the short-term versus long-term point, right? Because Rakshit, I think, made a beautiful point about how to think about it mentally, right? Think of it like this, folks, right? And I think this is Warren Buffett. This is Warren Buffett. I think this is one of his most memorable saying, right? The stock market is actually a very simple machine. The stock market exists just to do one thing. The stock market exists to transfer wealth from the impatient to the patient, right? The stock market exists to transfer wealth from people who think like the left-hand side of the slide to the right-hand side of the slide. So we have tried to train ourselves to be on the right-hand side, not because we think there's some great virtue, but if we are not on the right-hand side, if you're not on the right-hand side, the stock market will take away your wealth, right? So just remember that the stock market exists just to do one thing. It exists to take away wealth from those who are impatient and give it to those who are patient, right? And that should focus everybody's mind to the right-hand side. And how do you train yourself to push your mind towards the right-hand side? Rakshit, over to you.
Sure, thanks, Saurabh. So there are lots of examples, and I can maybe give you a quick list. But every example is different from the other, given the different period in the evolution of the company that is under consideration versus other companies, right? So let me give you some examples. So take, for instance, a Dr. Lal Path Labs, right? There are two very broad areas around which we've seen this company evolve in the last 3 years. One is around decentralization of decision making, right? According to us, 3 years ago, most of the decisions were made by one person at the top, right? The CEO and the MD, I think MD and CEO previously. And today, there are at least 3 people at the top that we hear about whenever we do our ground level checks in terms of who is driving which initiative independently, right? It's no more just the one name. At the same time, Dr. Lal has totally shifted its mindset from being Excel sheets oriented and process oriented to becoming system oriented. That's a massive mindset shift. Many companies theoretically know that they have to do it. Some of those companies make an attempt to do it, and very, very few companies successfully make the shift from human-oriented processes to systems. And that's actually the need of the hour, given the way technology as a toolbox is evolving around us, and it will define the successes in every industry towards businesses that use that toolbox effectively versus those that don't. Dr. Lal has successfully made the efforts, and we can see the outcome of those efforts. The shift is actually happening after a few sort of hiccups, I would say 3 years ago, 2 years ago, around this shift. Those are two dimensions around which Dr. Lal has evolved, right? Tech orientation of the business and institutionalization of decision making at the top, right? Now, a Page Industries has evolved around one of these two, not both. So a Page Industries has become a massively tech-oriented company today compared to what it was 3 or 4 years ago. It's all the demand forecasting through Blue Yonder, replacing distributors' discretion on what the distributor will order in his sort of 5-kilometer radius basis, his ability to forecast demand using the human brain. Auto replenishment systems, rather than the salesman of jockey going to the distributor maybe towards the end of the quarter and saying, I have to meet my sales target. So why don't you try out this inventory? Or even for other reasons, uneven distribution of merchandise across the channel, right? Which could be the risk of running it in a human intervention manner, being substituted by auto replenishment system, driving the distribution channel in the front, right? It's a massive upgrade. So those are some of the upgrades that Page has done, but there's another area where Page has evolved. Because of these upgrades, Page has actually become a company which can handle 10 times more SKUs than they could 3-4 years ago, right? Because in order to handle a wider range of SKUs and provide availability in the channel of all of those wide range SKUs, you need systems and processes of a very upgraded level. Page went through those upgrades in systems and processes. And today, if you see, let's say in women's innerwear, right? Page is not only in comfort-oriented innerwear products, it's doing fashion-oriented innerwear products as well. The strapless bras, the lacy products, the sort of number of SKUs in women's innerwear has significantly exploded in the last 3 years for jockey. It has added kidswear as a category. Loungewear is very, very SKU heavy as a category, right? Remember, those of you on the call consuming loungewear as a category, you won't want to have 4 or 5 pajamas or 4 or 5 t-shirts which look exactly the same. You won't mind having 4 or 5 undergarments which look exactly the same, right? So the number of SKUs in undergarments, particularly men's, will be far, far lower than the number of SKUs in loungewear. And hence, if a company has to do men's innerwear on one hand, women's innerwear somewhere in the middle, and loungewear and kidswear, the range of SKUs is so wide, something that you can't handle without systems. 3-4 years ago, Page couldn't have done this, what they're doing now. And all of these are initiatives that they have taken in the last 3-4 years. Interestingly, there isn't a single company which does Triumph Enemor type of product as well as Rupa Lux dollar type of products, right? Jockey is bridging that. It's a massive opportunity to bridge. The leverage is massive from one category to another and various other aspects, and provides massive longevity to the business. It's difficult to execute, which Page is doing, right? Asian Paints is not a company which has upgraded massively in the last 2-3 years around tech. So if you are an analyst assessing Asian Paints and looking for tech upgrades, well, incrementally they've gotten better, but it's not radical, because Asian Paints already was a reasonably tech upgraded franchise. But having said that, what Asian Paints has done is it has taken the opportunity with both hands, where home decor was significantly higher in demand in the last 2-3 years compared to normal, and expanding into home decor in a very aggressive way was a massive opportunity that Asian Paints has started to capitalize on, right? So that's a business which has transformed itself in a very different way. Titan, right? Titan was a business which 3 years ago, had you analyzed it, was just Tanishq. But now Tanishq is a far smaller quantum of present value of expected future cash flows compared to what it used to be till 3-4 years ago. Today, there are other elements added within Tanishq. It is not just non-wedding jewelry, it's wedding jewelry as well. Then there's Carrot Lane, then there's eyewear, even the wearables, the watches, they've started to nail it, so on and so forth, right? It's a very different business today compared to what it was 3-4 years ago. And if it continues on this journey with the Naira and these handbags that they've launched, some of which will be successes, some of those initiatives will be failures, but the value add to the investor via the success of some of these initiatives is massive, right? So on and so forth. And I can go through how Bajaj Finance has evolved, how ICICI Lombard has evolved, right, with the healthcare muscle added now, which wasn't present, so on and so forth, right? So too many parts of evolution. The rate of evolution in this portfolio is remarkable. You won't find a 2-year, 3-year period ever in the last 20 years where a portfolio of high quality companies, almost all of them underwent a massive upgrade in the quality of their competitive advantages, the runway of longevity in front of them through those initiatives. And those are the initiatives you will capture if you follow the right-hand side checklist rather than the left-hand side checklist, right? The left-hand side checklist won't tell you that Titan actually has evolved, Asian Paints has evolved, Dr. Lal has evolved. The left-hand side checklist will only tell you Tata 1mg has entered, Grasim is entering, Jio Finance might enter, right? But the last right-hand side checklist will actually tell you far more about what makes money for investors in the longer run. Pramod, back to you.
Thanks, Rakshit. So there's one question, the ubiquitous question on timing the market. So there are multiple people asking similar questions. They're coming at it differently. One is saying that, look, of course, since inception, your CCP portfolio shows outperformance. Does that mean that the fact that you came in 2018-19 made a difference to that experience as opposed to coming in 21-22? Somebody else has asked the similar question at the stock price level or the individual stock level, where had you bought Bajaj Finance at 7,500, would you still expect 20% compounding in a 3-year time frame? Or had you bought Asian Paints at the local maximum of 3,500 or so, would you still expect a 20% compounding on a 3-year time frame? And finally, an investor has asked, I'm sitting on surplus funds. Should I invest now? Is this the right time to invest? So I think the answer to the first two will effectively give you the answer to the third one.
Yeah. So the answer to the second one, to begin with, can be had from this chart. Most of our portfolio companies have had a share price progression akin to the red line here, right? There'll be some phases of share price correction, but broadly speaking, the chart will look like this over a longer time period, right? As a result, more often than not, you will find the share price or NAV of this portfolio being at all-time highs, right? So for instance, if you chop off this chart at any time level, 90% of the cases, you'll be nearing the all-time high entry points, right? And still, the chart delivered a healthy return after having entered at all-time highs with a 90% probability, right? Why is that? That is only because if the underlying fundamentals are compounding at a very healthy rate, and the compounding of that fundamentals means that fundamentals are at all-time highs, then because in the longer run, fundamentals drive share prices will also be at all-time highs. Not always. There will be disconnects between fundamentals and share prices emerging every once in a while. Those disconnects will be relatively short-lived. And by short-lived, I mean they won't last for 3, 4, 5 years in most of those occasions. In most of the cases, they'll not even last for 12 months, but they might last for 6, 3, 12, 18 months. But those disconnects will always be temporary, because if the fundamentals are progressing and they are going to be at all-time highs most of the times, then the share price will also be at all-time highs most of the times, right? So that's the answer to the second question. So it's actually going to be very rare for you to find lower than all-time highs. When I say rare, it's a 10-20% probability. 80% of the times you'll be all-time highs. The second part, in fact, the first question that Pramod you relayed. So think about it like this: the price to earnings multiple of, or price to book, I remember, of a Bajaj Finance, since that's the stock you picked up. Price to book of a Bajaj Finance 3 years ago was, I think, 6 times or 7 times. 5 years ago was also 6 or 7 times. 7 years ago also it was 6 or 7 times. The price to book of Bajaj Finance 3, 5, and 7 years ago was no different from the price to book of Bajaj Finance 1 year ago. Now, interestingly, in 7 out of the last 10 years, Bajaj Finance has had more than a 20% drawdown for a couple of months, for 3, 4 months, in every single year. At the same time, in 9 out of the last 10 years, on a calendar year basis, Bajaj Finance has compounded on average at a rate of 30% plus. So saying that I will wait for a Bajaj Finance's price to book to correct to 3 times, and that's when I will enter, it will work only if the fair value of Bajaj Finance was less than 6 times price to book. And it will work if the fair value of Bajaj Finance is less than 6 times price to book. Waiting for a lower entry point makes sense. But if you are entering into Bajaj Finance when the fair value is way higher than 6 times price to book, then every time you buy it at 6 times price to book, you will make money. It might be that after you've bought it at 6 times price to book, in the next 2 months, you're down 20% and then you go up 50%, but you will make money, and you will make very healthy money over the longer term. And hence, yes, it is true that had you bought Bajaj Finance at its all-time high, either in terms of the share price or in terms of its price to book, historically, you would have made money. And in that regard, then answering the last question, as Pramod mentioned, the first 2 questions that actually answer the third one. Honestly speaking, so I'm a regular investor in our funds. The tranches that are topped up into these funds 1 year ago, which obviously so far haven't made money, but those tranches will make a very healthy rate of compounding over a 3, 5, 7 year horizon, even though they were invested at all-time highs, even though they were invested at, say, Bajaj Finance price to book of 6 times, because they were invested at prices below the intrinsic value. And one way to look at it is this chart is a 3-year period. It is not that it was only in the more recent times that the 3-year period gave you a blue shade. The 3-year period has actually given you a blue shade, or the 5-year was actually part of the question, right? That we've, since inception, it shows outperformance. The 5-year period has actually given the blue shade forever, right, in this portfolio. It's not just now that 2018 entry was a lucky point, and hence 2023 5-year period shows an outperformance. In fact, historically, the 5-year period has, in 95% of the cases, showed an outperformance and a very healthy absolute return. You elongate the 5-year to 7-year, as I said, it'll be all blue. Every 7-year period in this sort of a philosophy, regardless of interest rates, inflation, American economic growth rate, regardless of anything like that, sort of a macro factor, every 5-year period, 7-year period would have given you a blue shade in this sort of a philosophy. Interestingly, look at the yellow. That yellow has an underperformance as the reason for the yellow, and the quantum of underperformance you can make out here is less than sort of, it's a low single digit level of underperformance, near about break even vis-a-vis the benchmark. So effectively, the 5-year time period has never given you unhappiness. And during the yellows, you can look at the absolute returns over a 5-year period, which was, I mean, these are not CAGRs, these are absolute returns. They were significantly healthy, right? So that's how maybe you can answer that question.
Yeah, I think for those who have listened to us over the last 4 years, you'll find it repetitive, but we keep saying the same thing over and over again. Whenever you have surplus money to invest, you need to ask only 2 questions. One, what is my time horizon? If it's longer than 3 or 5 years, you've given yourself that much of an advantage to face this volatility that's inherent in the stock market. And second question is, do I believe in this investment approach or investment strategy? If I do believe in the underlying stocks that these companies will deliver a reasonable outcome over that investment horizon, any time is as good as it can get to invest, because there is no other alternative. As much as we would love to time ourselves to perfection in terms of getting everything as cheap as possible, what we've learned is the real world is a volatile place and an unpredictable place. And therefore, we'd rather focus on what we're capable of understanding and controlling than try to be too cute in terms of timing ourselves to perfection. One thing about sort of a corollary question, Rakshit, which points to our pre-balancing or post-facto fortitude worth highlighting is, a couple of investors have asked that, look, this continuous investing works if you have the additional money, which helps you take advantage of these drawdowns and so on. What if we don't have that luxury? How then can I still benefit from these irrational movements of stocks within the portfolio? And
yes,
you might also want to address one other question from an investor who understands the concept of rebalancing, but says that, have you guys done any study about the tax implications? It's not that, to gain that extra percentage points, we end up paying more tax. Have you analyzed it on a net of tax basis?
Yeah, no, both are very good, very relevant questions. They add massive, I mean, the answer to this question actually adds massive alpha or excess return to the overall portfolio. So to begin with, if it's an 80% probability of sort of the all-time high being a very good entry point compared to a drawdown point, right? If there's, as I previously mentioned, if there's an 80% probability that in this sort of a chart, the all-time high was a very good entry point, then probability-wise, sitting on cash and waiting for a lower entry point itself gives you the 80-20 probability of a loss, right? Cash calls in 80% of the cases will cause a loss. The degree of drawdowns in the remaining 20% will be very small and won't be able to cover up for the adverse impact of the cash calls during those 80% of the times when all-time high was not a bad entry point, even from a short-term perspective. Right, so that's one part. The other part which Pramod was referring to was every time there is a dislocation in our portfolio constituents' share prices, we take massive advantage of it. In the last 12 months, there were several such dislocations, right? So Dr. Lal went through a drawdown during May. Bajaj Finance went through a drawdown during December. And now I think November, December. Divi's Labs went through a drawdown gradually throughout 2022. If you were to make cash calls, the problem will be Dr. Lal and Bajaj Finance won't go through a drawdown at the same time. But within the portfolio, at any point of time, one particular part of the portfolio will be undergoing a drawdown, which creates an opportunity. An opportunity which you can encash only by saying that, look, let me shave off from the part of the portfolio which has not gone through a drawdown. And with that shave off quantum, let me buy part of the portfolio which has gone through a drawdown. This rebalancing you can actually do as well whilst being invested as you can do if you were not invested, right? And in fact, if you do it whilst being invested, you get both the upside of those 80% probabilities when there wasn't a drawdown, and you also get the upside of 20% probabilities when part of the portfolio underwent a drawdown, and you could do rebalancing to actually benefit from it, right? To quantify, prior to us using margin of safety and sustainability, the new tool, you might have heard us in some of our forums. Prior to us using that tool, the degree to which we were taking advantage of this was slightly lower than the degree to which we've been taking advantage of it now. But despite a slightly weaker variant of the tool of rebalancing than we have currently, there was more than a 200 basis points positive impact of rebalancing over the last 4 years on annualized returns, right? That's the quantum, historically speaking. Going forward, the expected outcome is even higher. But this is a very frequent occurrence. Just to give you a sense, and this is something which we might actually publish another newsletter on at some point in future. In 7 out of 10 calendar years, a typical CCP company undergoes more than a 20% drawdown during the year. In 7 out of 10 calendar years. Although it is true that only in 2 out of 10 calendar years, the CCP company delivers a negative return over the entirety of 1st Jan to 31st December. But despite only in 2 out of 10, the return being negative for the 12-month period, in 7 out of 10, in the interim 12-month period, there is a more than 20% drawdown. So drawdowns are very frequent, even for the most consistent compounders, right? Just that they don't all happen at the same time. So rather than a cash call trying to benefit from the drawdown through the NAV of the portfolio, it's actually better to benefit through the drawdown by rebalancing within the portfolio. And it's far more rewarding, right? 2019, Page Industries, Van Use and Entry, massive drawdown, more than 50%. 2020, Bajaj Finance, COVID, unsecured lending of Bajaj Finance, massive drawdown. 2021, I think Grasim Entry, Asian Paints, 35% drawdown. 2022, multiple, Titan, Dr. Lal, Divi's, Bajaj Finance, Page Industries, all of them went through a massive drawdown at different points of time. And hence the benefit of this. Now, coming to the question of tax impact. So typically, on average, the advantage of a drawdown that we've been able to capture is about a 40% on average advantage for the rebalancing quantum, right? That 40% roughly, you can say the stock that we are shaving off was probably 10% ahead of or 15% ahead of the rest of the portfolio. And the stock that we were buying was probably 30% below the rest of the portfolio. So that's the 10% higher of the shave off and 30% lower of the repurchased. That's the 40 roughly. I mean, I'm giving a rule of thumb. We are not doing rebalancing to benefit from only a 5% advantage on the rebalanced quantum. We are doing rebalancing to benefit from a 30, 40, 50% advantage on the rebalanced quantum. Then if you do the maths that on any quantum, if the targeted outcome is 40 and the real outcome might even be in the worst case scenario 30 or 20, the advantage of the rebalance will be far greater than capital gains tax, even if the entire shave off was capital gain. Even if the entire shave off was capital gain, on that you had to pay, let's say, 10% tax, because if the entirety was capital gain, then probably it certainly was a long-term investment, which probably became 10x in a very long period of time, etc. And if that is the case, then the shave off is all capital gain. On that shave off, which is all capital gain, you pay 10% as the tax. And that's the worst case scenario I'm talking about, because all of it is capital gain. And after paying that 10% tax, you target a 30-40% upside on that proportion through the rebalance. Even net of brokerage and net of capital gains tax, this is massively, massively positive. On an average, it won't be 100% of the shave off will be capital gain. Typically 20, 30, 40% of the shave off will be capital gain for an investor who's been with Marcellus for only 3-4 years. Once there are investors who've been with Marcellus for 10 years plus, there will be some who will have 70-80% of the shave off as capital gain, and the maths will look slightly different. But even then, it will be a net positive impact of rebalance in a very meaningful way, right? It makes a lot of sense.
Yeah, there's a follow-up. I might as well address it myself. There's a question from a client saying, just to understand rebalancing well, does Marcellus continuously do rebalancing on its own, or investors need to ask for it? It is a discretionary portfolio in the sense the fund manager has full discretion on how to manage the portfolio. So you don't need to ask for it as investors. When we see these opportunities, we will act upon it in your portfolios without you asking for it. The next question, Rakshit, is on valuation. There are multiple questions worth taking it as a group. One, I think somebody's written saying that Saurabh mentioned in some interview that our intrinsic value of Divi's Lab is 6,000. Now, the question there is, what is it that we are seeing that the market is not seeing? It's not like many of these stocks in the portfolio haven't been re-rated. From their perspective, they have done well. The market has rewarded that. Related question, I think worth addressing in the context of Bajaj Finance, given the recent drawdown and given the recent results. Related question is, it was all fine at 6 times price to book when it was growing at 30% plus. Clearly, that was what the market was expecting, and that's what the market was paying for. Now that that growth has fallen, we don't know if it's just one quarter or structural. Isn't it sort of logical that the stock gets derated? It was fine over the last 7 years when it was at 6 times price to book because it was growing at 30%, but with the growth slowing down. And thirdly, a client has asked, what do you look for to assess sort of gradual deterioration in a franchise, deterioration in the fundamentals? Because most of the time, these fundamentals don't have a sudden fallout. What do we track to see if what the market is paying for or what we are paying for is not in line with the developments in the stock? So all three are in some ways linked to valuation and worth taking our clients through our approach.
Sorry, I was on mute. So on the first bit, if you can see this Moss slide, the drivers of intrinsic value and hence the assessment of whether you're buying a company at an undervalued level. The drivers of intrinsic value are, broadly speaking, two. One is the rate at which it will grow, in which regard I think the Bajaj Finance question is valid. Is it that it will grow forever at a lower pace than what it did previously? And hence the rate of growth does have an impact on valuation. The second is the longevity of that growth. Between these two, the rate of growth is something which, I mean, two different analysts on the same stock can differ by say 2, 3, 4% at max. I doubt if people will say on the same stock, one analyst says next 3-4 years, I expect 5% rate of growth, and the other analyst says 35% rate of growth, right? It won't be so divergent. It might be 20 or 25, it might be 25 or 30, or so on and so forth. So the spread between the rate of growth expectation of one analyst versus another won't be as material as will be the longevity, the degree of sustainability of that rate of growth, right? And longevity is something that encapsulates lots of softer aspects as well. How do we assess longevity? Many of you would have heard us talk about our longevity framework. Two very integral parts of which are lethargy, which is the capital allocation to deepen existing core, add new revenue growth drivers to the core, and radically disrupt your own industry. These are capital allocation decisions which should have tangibly been taken, and we need to be convinced that these decisions are likely to be taken even in foreseeable future, and hence those capital allocation decisions will sustain the rate of growth beyond just the next 3 to 5 years. Secondly, it's the institutional aspect. Decentralization of decision making at the board level, at the CXO level, at the management team level is very, very important. If that decentralization is there, it provides both continuity and scalability to the decision making of that company. And continuity and scalability of high quality decision making, whether it be decision making around capital allocation or decision making around, say, execution initiatives in the here and now, the continuity and scalability of decision making adds significantly to the longevity of growth. So much so that, in fact, if there are two analysts looking at the same company, one says, I expect 25% growth for the next 5 years, the expected fair value of that company is no more than roughly 25%, 25 times PE multiple. Rule of thumb, right? 25 times PE multiple, if the 25% rate of growth is expected only for the next 5 years, and thereafter you expect the business to gradually sort of decay to a very low growth rate. Whereas if the other analyst says, well, I also expect 25% rate of growth, but not for the next 5 years, I expect it for the next 15 years. Then as a rule of thumb, such a company might be fairly valued at 80 times PE or 100 times PE roughly, right? And longer than 15 years, even higher than 100 times PE, right? So that's the degree of impact on valuations from longevity of growth, which actually is a far more underappreciated variable for consistent compounding than just the rate of growth. Rate of growth is also very important, right? But longevity becomes a far more important. They are both mutually exclusive, but end up giving an interplay to the valuation. Both are important, but it's relatively easy to underappreciate longevity. It is reasonably possible to appreciate the rate of growth in the here and now, right? So that's in a way answering the first and third question. When you look at, say, a Divi's lab, this is how the sort of flow chart on the right hand side on this slide is what goes on inside the engine of Marcellus's valuation, and that creates a rebalancing opportunity. If the share price falls and the intrinsic value was actually unchanged, the margin of safety opens up and we buy more of it, right? Now, coming to the second question, which was about Bajaj Finance, right? So yes, it is absolutely correct that who knows if the 2 or 3% lower rate of growth that they reported this quarter on a year-on-year basis, what if that lower rate of growth is a permanent lower rate of growth, or QOQ? I think QOQ was 4% or something like that. What if they report 4% QOQ forever now, and hence annualized growth rate of 16, right? And certainly there will be massive question marks on the fair value in our valuation engine as well, not just for the broader market. And that's a very important factor to consider. But two ways to understand why you don't need to have a knee-jerk reaction and say that, look, 4% growth, oh my God, now it'll slow down. One, what has changed within the company's execution, growth prospects, runway, which gives you the belief that a lower rate of growth is a far more sustainable outcome than a higher rate of growth, right? If you've seen lethargy, if you've seen complacency, if you've seen fatigue in management's decision making, if you've seen market share gains from competitors for reasons which are sustainable, if you've seen saturation of growth runway because market share has become 70-80% in the relevant category, those are some of the reasons why it would be fair to say that, look, the rate of growth is probably permanently slowing down rather than temporarily. Now, what are we looking at when we assess all of those parameters, right? It's quite interesting to know that Bajaj Finance actually embarked on a massive digital transformation journey. And now, incrementally, it is getting business even from its digital media, right? Which is the app or the web. And here one needs to keep in mind that as the company is scaling up its business from through the new digital platforms, customer acquisition becomes even more important, right? And that's where the latest results, the most recent results, were very, very interesting. Their customer acquisition run rate accelerated, right? Customers acquired, I think in the last quarter were some 20% year-on-year growth, right? In the December 22 quarter, it was a 20%, 19% year-on-year growth. One of the highest rates of new customer acquisition. Why is it important? Once you are becoming a business which is far beyond just lending, right? Every new customer acquired, even if that customer has a lower ticket size of loans, adds a lot more to the profit because you're going to sell 4 different things to the same customer in future through your fintech transformation that you're achieving, right? So, for instance, the AUM per cross-sell franchise of Bajaj Finance in the last 5 years has been only 3%, right? Now, you can say that's where the disappointment is, perhaps, that even after acquiring so many customers, the AUM per cross-sell franchise, as in the AUM per unit customer who's been cross-sold a product, the AUM is hardly 3%. But interestingly, the PAT, the profit after tax, and cross-selling is in roughly more than 2/3, I think 3/4 of the customer base of Bajaj Finance undergoes cross-selling. Profit after tax per cross-sell franchise is up 14%. And when you add to it the total customer franchise, that's where the total PAT, right, is up 38% in the last 5 years. Now, given the digital initiatives, the proportion of fee income in Bajaj Finance's overall profitability has been increasing. And this is visible from a higher share of fee income in PBT, right? So the fee income, core fee income as a percentage of PBT used to be around 20-21% in FY18. That went up to 27, 35, 41, like that. And currently it's somewhere around 30 plus, right? The core fee income as a percentage of PBT is increasing, it's growing thanks to the digital initiatives. And hence, rather than the AUM per customer, which is a lower number, being the focus area, for an analyst at Marcellus, the focus area is more profit per customer, given that it is a bigger cross-sell franchise than previously, and customer acquisition is actually accelerating. That's what we looked at when we looked at the results. We got more excited about the customer acquisition engine firing rather than the AUM piece only. AUM piece is very important, but that's not the only important area, right? So long answer, but yeah, that's how we assess Bajaj Finance.
Great. Thanks, Rakshit. So that brings us to the end. There are quite a few questions which perhaps require whole webinars by itself. So there's lots of demand for forensic. We'll definitely come back to you with another episode of forensic accounting. There's one that we did a couple of years ago. I think it's time for a refresh. There's lots of questions around fundamentals. I think next webinar for CCP will revert back, and it'll be a good time because I think most of our companies would have reported by then. So there are a lot of stock specific questions. We can perhaps dedicate an entire webinar to the whole portfolios. Long-term fundamentals as opposed to the short-term stock prices. There are a few questions which perhaps better addressed in person, because these are very specific questions. So we'll reach out to you wherever unanswered. But thanks everyone for dialing in. Thanks Rakshit for explaining so patiently. Until the next webinar, see you all.
Thank you, Pramod. Thanks, everyone. Bye.